Hello, this is Smart Money. My name is Kura and joining me in studio is the money master, the guru, the man who makes the rands make sense, Mr. Warren Ingram.
The host for the most.
We're all familiar with investing on the stock market, buying shares. But shares have different prices. Some share prices are 1 cent, others are 1,000 cents. Well, innovation never ceases in the investment world. And we can buy a share of a share, fractional ownership on a single share. We're not going to be talking a lot of jargon today. My money man is going to break it down to us so that we can understand it. Right. How much is a single Berkshire Hathaway share?
It's about 217,000 US dollars.
In rands, that is how many millions?
That's a lot.
It's a lot.
It's a lot.
Okay.
It's over 3 million bucks.
For one share. Okay.
And then we have in South Africa, we have a share like Naspers, where you're trading at about 2,000 bucks a share, 2,000 rand.
And that thing used to be at 14 bucks.
And that was 14 bucks. So we've got some expensive shares here. And I think that's always been a problem for someone starting out. You know,
sure.
you start out, you're earning a salary, and you've got 50 bucks, 100 bucks to save. Most of the time, when you buy a share on a stock exchange through even an online broker, the cost is going to be about 100 or 150 rand just to buy the share. So that's your transaction cost. So if you've only got 100 bucks to save every month, how do you buy shares?
Yeah, okay.
So it excludes this entire market of new people that are saving, that are entering the market all the time. You know, every year we've got new salary earners that would love to buy shares, and they're excluded.
Okay. Why should I be buying shares before we even get to the technicality of it? Why should I be buying shares? Those things are risky. I mean, I lost money in African Bank. I lost money in
nothing else, because you've made so much money in everything else. So I think there's a basic reason. One, the stock market is very often going to be the best place for you to get capital growth on your money over a very long period of time. So if we look back over long periods of time, the stock market gives you about 7.5% growth above inflation. So if inflation is running at 6%, you're getting about 13.5% as a normal average on your stock market investments. Now, government bonds, as an example, are giving you about 2% above inflation, so 8%. That's not a great return for someone who's looking for good capital growth. So shares become one of the great ways that we can, as ordinary South Africans who have a little bit of money to save every month, how we can build real wealth.
But when you talk about shares, you're talking about a whole category. Within that whole category, you're going to have diamonds and dogs. How do I start knowing or being able to sniff out which are the diamonds and the dogs?
I think you go one of two routes. One, you just buy the market. So you buy an index, because nowadays you can buy the whole stock exchange, or the top 40 shares in the stock exchange with one share. So you don't need to go and buy each of the
individual. Break that down to me. You're jargoning me here. Buying the index, what does that mean?
In other words, let's just use the top 40, because that's one that will get spoken about quite a bit. So you can buy all of the 40 biggest companies on the JSE, but with one share. Instead of having to go and buy each of those 40 companies, you have one share that actually physically owns each of those 40 and packages it together as one.
Okay, so when I hear on the radio the Johannesburg Stock Exchange, the Aussie 40 did this or that, that's the number they're talking about. But with me buying this exchange-traded fund, with my one purchase of one share, I've actually bought a little piece of all of those 40s.
All 40.
Okay.
And I think for someone who doesn't want to put the time and the effort into actually doing research of individual companies, that's kind of your no-brainer way. I put a lot of my own money into index investing. I think I don't want to go and spend all the time analyzing every single company in the stock exchange. So I'll just let the stock exchange do its work for me. Most of the time, that stock exchange investment, where you buy the whole stock market, will do better than about 8 of the other funds out there, the other unit trusts that are out there trying to do better than the stock exchange. So it's not a bad deal. The second option is you go and do some research on businesses that you understand, where you've got some kind of competence in understanding a company, and it's a brand that you might be familiar with, and you say, I'm going to do a bit of homework, I'm going to do my research, and I'm going to go and buy shares in that business. That's kind of common sense investing. And what's really interesting about common sense investing is if you do it cleverly and you do it over a long period of time, often that common sense portfolio does a lot better than anything else. So you go where you shop, where you buy your clothes, who you use for your cell phone, and who you use to watch TV. And you just say, okay, great, those are good businesses. I think as a customer they're treating me well, their price is fair, why don't I buy them? So that's the common sense way of doing it.
Well, common sense is what we try to bring to the fore on Smart Money. On the other side of this break, we're going to be talking about fractional ownership of shares with an expert. We'll see you just now.